In this section of the module, we'll be looking at writing the Part A essay in detail. For the introduction, as this question mainly revolves around foreign direct investments, it'll be good to define FDI here. FDI refers to the planned spending by foreign firms on capital goods, such as plants, machinery, and stock of raw materials. To show the use or significance of FDI, you can write that it is a component of your aggregate demand and that it is important in determining the economic growth and development of a country. Set the direction of the essay by giving a brief overview of your answer, which is that your essay will explain the factors affecting the volume of FDI a country receives, namely expectations of firms, government policy, and a stable macroeconomic environment. Zooming into the first requirement, which is how expectations of firms affect the volume of FDI, we'll be using the MEI curve as a tool of analysis to make our answer more rigorous. The MEI curve shows the inverse relationship between interest rate and level of desired investment, holding the price of the investment constant. Thus, a change in non-interest rate factors could shift the MEI curve and hence the level of desired investment. Using the Peel format, the main point of R1 is that a change in expectations of businessmen would cause a shift of the entire MEI curve and also influence the volume of foreign direct investment that a country receives. Elaborate this point by explaining that should businessmen be pessimistic about the future outlook of the economy, and this usually happens during a recession, the MEI curve shifts leftward from MEI naught to MEI 1 in the figure above, causing the level of FDI to fall from I naught to I1. Contextualize your answer by giving a relevant real-world example, such as in the case of Japan, where poor business sentiments have resulted in a fall in FDI since the 1990s. Finally, always link back to the question by telling us, hence, business expectations can affect the volume of FDI. For requirement 2, the main point is that government policies can also affect the volume of FDI a country receives. Elaborate by writing that should the government lower their corporate tax rate, expected post-tax profits of investment will rise. As the expected rate of returns from investing have increased, the MEI curve shifts rightward from MEI naught to MEI 2, and thus FDI will increase from I naught to I2. A relevant example to use here would be Singapore, whose corporate tax rate of 17% is one of the lowest in the world, thus attracting higher volumes of FDI. What's noteworthy here is that these lowered tax rates are also coupled with business optimism due to our country's stellar economic performance across the years. Government policy may not only be viewed from the angle of tax rates, but also through grants. You can further elaborate your answer by writing on this point that if the government gives out grants to new investment projects, cost of capital will be reduced, making capital relatively cheaper than labor. This encourages firms to substitute capital for labor, thus increasing their foreign direct investments. For your optional R3, an adequate explanation of how a stable macroeconomic environment affects volume of FDI is sufficient. You can explain a stable macroeconomic environment from three angles. The first one being a low and stable inflation rate, which means that the GPL is increasing at a low and steady rate. This allows firms to predict total revenue, amount of products sold, as well as production and raw material costs, thus profits with greater certainty. Hence, they are more likely to undertake FDI in such a country. An alternative angle would be to explain a stable exchange rate, which assures foreign investors that their profits from undertaking FDIs would not be eroded by exchange rate losses when converted back into the domestic currency. This will thus increase volumes of FDI received by a country. On this note, the Monetary Authority of Singapore takes a gradual appreciation policy to ensure both a low and stable inflation rate as well as a stable exchange rate, in mind of attracting more FDIs into the country. Lastly, you can write from an alternative angle of healthy public finances, That raises business confidence that the government would not undertake policies that threaten the profitability of their investments, such as raising taxes when facing a debt crisis. During the Eurozone crisis, due to their large debt, Greece saw a plunge in FDI volumes. Explaining one of these 3 points briefly is sufficient. After which, link back to the question by stating that, hence, a stable macroeconomic environment would enable firms to have a higher expected net rate of return, as they do not have to buffer for unexpected losses, thus affecting the volume of foreign direct investment. Lastly, the conclusion should be short and sweet and wrapping up the key points explained in your essay. In the next bonus part, we'll be looking at factors affecting FDI specifically in Singapore.